All right, Luca and Greg, so excited to have you both on the podcast. Thank you for making the time today. How's it going?
Luca, you can't type. It's loud.
Can't type, Luca. Will we start?
Let's start again.
He waited 2 seconds.
Drew, promise, we will stop misbehaving.
All right, take two. That's Luca and Greg, founders of M0, a stablecoin infrastructure platform for builders. Unlike Circle or Tether, who simply extend traditional banking rails on chain, M0 is rebuilding the entire stack from scratch, creating a composable and modular infrastructure to enable anyone to embed and issue programmable Treasury-backed dollars with just code. No bank partnerships required. Here's our episode with Luca and Greg. Season 4 of Stableminded is powered by M0, the stablecoin platform for builders. M0 recently crossed 230 million in native stablecoins minted, helping builders turn payments from a cost center into a core revenue center. This season, we dive into how companies like Cast, Playtron, Wormhole, and others fit into this dynamic ecosystem. With M extensions, builders can fully customize their stablecoin programs. And with their orchestration APIs, builders can scale minting and redemption freely. Tune into episode 1 of this season to meet Luca and Greg, co-founders of M0. Stableminded is for informational purposes only and does not constitute financial advice. All right, let's start with intros. Luca, Greg, why don't you guys both introduce yourselves and then we'll get started.
Thanks for having us, Drew. I'm Luca. I'm the CEO and one of the 2 co-founders of the M0 project. I'm an absolute stablecoin nerd, in good and the bad sense. So I'm sure we have a lot of things to talk about today.
Yep, and I'm Greg. I'm the other co-founder. I've been working on stablecoins for almost 10 years now. Yeah, I'm excited. I think this is the first time Luca and I are on a podcast together, so we're see how this works.
Great. That's great context. So let's start there. Let's talk a little bit about you both. How did you guys first meet? Like, what was the first time you guys actually bumped into each other or had FaceTime? And then how did that evolve into what it is now, which is like a co-founding relationship? I'm sure there's a lot there.
FaceTime's a different question, but I'll let Luca tell the origin story.
Yeah, it's actually interesting because me and Greg, we met in person for the first time when we had already started M0, and we never met in person before. Something we didn't tell our investors back in the days. I hope the guys will forgive us. I think Greg and myself met, I think it was 2021, if I'm not wrong. I got really fascinated by MakerDAO and MakerDAO's attempt to connect the protocol with the real world of lending. This was the beginning of a so-called real world asset initiative that Maker pioneered. And so I was helping the DAO trying to create some sort of structure and framework not to be assaulted by low quality credits that want to get cheap financing through the DAI repo window. And Greg, who had actually spent a few years at Maker on the DAO side, had just left the Maker project, and he was trying to help the first regulated financial institution in the US actually to create a credit line with the protocol. So we were working on the same initiative, but on 2 different sides of the trade, so to say. That's how we met. We started to get to know each other. We also understood on our skin the dysfunctionalities of what we wanted to do within the context of one of those early day crypto DAOs that was full of cash but didn't really have the governance framework and the probably professional maturity also to approach this very complex problem.
Yeah, Greg, you just being in your position, working there directly, and you were running the business side of that business, like strategic partnerships and revenue. Was that right?
Yeah, I mean, well, you need a little history on Maker here. So Maker started as a DAO, meaning it was a bunch of us in a chat room just talking. This was back in like 2015, 2016. And then we started the Maker Foundation together. Varun was the founder. He was always the driving force, but a bunch of us were involved in the early setup. And I joined on then full-time as the head of business development. So I was just in charge of spreading DAI around the world pretty much.
I'm curious the things that you would probably, in my mind, is a very interesting journey. A lot of learnings probably happened in the spreading around the world of what that was. What were some of the things that you saw, that you heard, that you experienced as challenges or, potential things that you saw that led you into M0, things that you feel like you guys are now solving that, perhaps MakerDAO didn't natively have organically, and how that was set up?
Yeah. So when we started DAI, when we launched it, we never in a million years thought that the problem would be collateral. We thought the problem was going to be adoption. So we went really strong and hard on the the adoption front. Like we had boots on the ground in Argentina. We completely captured that market. There was a period in 2018 where grandmothers in Argentina were using DAI as a payment mechanism. It was really cool. I think it's important to remember too that Maker today looks very different than it did when it launched. When it launched, it was almost like a be your own bank kind of protocol, where you would take collateral, you'd bring it, you'd generate your own DAI, and then you'd go use that DAI in the world. It doesn't do that anymore. It kind of morphed away from that because the problem we ran into was that there actually is not enough on-chain collateral to support a global stablecoin. And there probably never will be. You always need some connective fiber to the real world. And that's why in 2021, I had left my position as head of BD to go actually find that collateral. And as Luca mentioned, the first deal I brought to the table was a commercial bank here in the States called Huntington Valley Bank.
Yep. So the idea of collateral and the term that I've heard thrown around in some ways around this is the singleness of money, or helping money become what feels to be more of a shared system than something that lives in silos. What I'd love to maybe start our conversation in how people think about M0, because I think when you begin to peel back the layers of what you guys are doing, at least in my experience, you begin to get more and more excited around the structural problems you're really solving around money and how money operates. I know, Luca, when we first met in person at ETH Denver, that was really where you originally, when you were describing M0, that's where you really started, was how money is, how we can really rethink about money itself. I think what would be helpful for those who are listening to this podcast, who I think for us, we have a very stablecoin native group of people here who are listening. What would be really helpful is if, Luca, you could potentially compare or contrast the approach of something like M0 structurally from what I think a lot of people are very, at least right now, familiar with a company like Circle, which is in the stablecoin business as well, and how M0 takes a very different approach. If you could use that as like a baseline in your explanation, that would be great.
Yeah, and as you know, Drew, I spent years writing and researching and trying to create mental frameworks around money, because actually I joke often that, in my opinion, money is the most complicated, the most complex mass adopted product there is, really, because people use it and they don't ask themselves any questions, but behind it there is a very complex set of checks and balances and actors. And money is not real. Money is a social convention that is a product of several checks and balances. The money you see in your bank account does not exist, and this is in any way it's real, physical. It's just like the checks and balances have been working reasonably well to the point that we stop asking what's behind it, unless there's something that doesn't work, and then we go back checking actually what's behind it. 99% of the time, money has this property, is no question asked type of property. And this doesn't mean in any way, though, that the system that is currently at the basis of money is the most efficient there is, right? It's an old system, has roughly 100 years, is created on top of like antiquated institutions that are absolutely not tech friendly. They're very opaque, very inefficient, and that captures a lot of profits as well. Now, I think that if I had to differentiate a circle of this word with what M0 wants to do, is I would say a couple of things. First of all, what Circle is doing, or what they started by doing, and I mean, this was a very successful effort, of course, and Tether as well, was like, let's not challenge the way money is actually produced. Let's just create an extension of it to work on a new technology stack. Let's open a branch on chain. That's what USDC is. USDC is a virtual branch of commingled banks on chain. Now, they are not, at least at the beginning, now things are slightly different, but they were not challenging how actually money is created. They're just creating an additional payment tool that people can use on chain to do stuff, payments mainly. In doing this, so though they haven't really, and again, nothing against the Circle guys, but they haven't really improved the efficiency of the monetary system. And on top of it, they actually created a single choke point, which is creating additional fragility in the system, and they're capturing the vast majority of the upside of it. So definitely not crypto in the DNA, given that crypto was born actually to kill the middleman and distribute the upside across those who actually have ownership of use cases. What M0 wants to do is way more fundamental, and in two ways. First of all, M0 wants to recreate the system of checks and balances that actually is at the basis of money. So it's a system of checks and balances that seems complicated, but ultimately let you trust the fact that one M token is worth $1. And on the other side, wants to create a system that is able to redistribute this upside in a more fair way, and a system where those who actually want to integrate digital money in their stack, they can do it only with code, and they do not need to worry to engage and onboard with like old school institutions. That's why we are reinventing the monetary stack on chain by complying with regulation, well-designed regulation, and just like turbocharging completely how the builders of today of like new use cases on crypto rails can actually embed money and morph it in the way they actually see fit to their use cases. And we are completely agnostic to the use cases, right? It could be anything. So it's way more ambitious, way more fundamental, less easy to grasp because it's not a product, it's an infrastructure project. But we are seeing now, I think in the last few weeks, the fruit of all this work where people start building stuff on top of M0. And then you start understanding why it's actually cool, why people are actually using it to build cool things on.
It's been really exciting to work with you guys on this season because we're talking about this now and we've already started recording a couple of these other episodes with guests on what are they building on top of M0 and with M0. I think, and either of you guys can answer this, but I think for me, as we start the conversation, to really grasp the need here, because what you described is like that choke point or the institutional legacy way of doing things. In many ways, for maybe people in the United States or the developed world who have had their experience with banking hasn't been that terrible, at least in their own opinions. It hasn't maybe fundamentally broken them or failed them, maybe like in other parts of the world or other emerging markets, where that is very, very common and very, very present and very top of mind. If you could spend a little bit more time helping explain what you mean by that choke point or that the system that exists that you're trying to improve, and maybe for those who may not be as familiar with what those typical pain points might be, that would be great to uncover too.
But just before we cover that, I mean, I think the concept that people haven't had a bad experience with the banking system, that's Stockholm syndrome. They just don't know an alternative universe at this point. But like you're getting paid 0% on your savings. You're getting your savings inflated away every year while the bank goes out there, takes risk with your money and beats inflation because they charge 5 or 6% when the inflation rate is 2%. So I mean, just fundamentally, it's an unfair structure. And then throw on top of that you're using archaic payment rails that barely function. I mean, if you've ever tried to send a wire transfer, like that's all you need to do to know that the banking system is terrible.
I agree. The Stockholm syndrome is, I think, a great call out. You don't know what you don't know. So say more on that. Like, what are people missing? What is actually happening behind the scenes that I know you guys have such a intimate appreciation for, because you can see, and Luca, given your background working in the space that you've worked for many, many years, you've seen this, you've seen what's going on behind the scenes. I just think so many people, they've never really been exposed to how bad it really is.
Yeah, but I think it's, look at what's going on in real life, right? So banks were born to be one-stop shops for people to interact with the financial system. So you would deposit your money, you would talk to a branch manager, you would get a loan, and the bank would sell additional financial products for you, etc. So 100% of the financial activity of anyone was intermediated by a bank. Banks have been losing a lot of business in the institutional corporate side for decades. Like I think the vast majority of sophisticated corporate credit, etc., is actually managed by the shadow banking system. Even mortgages now are underwritten mainly by capital markets. But even if you look at, let's be more real, let's look at retail. When was the last time you went in a branch? And I bet that the vast majority of the financial actions you don't do them through banks. You probably do them through some sort of front end of money transmission or some sort of like fintech. So that in Europe you have Revolut, and you might have Venmo, you might have PayPal. These are all tech businesses that are built on top of financial institutions. So actually, the financial institutions have got way more remote, because like a bank that is a kind of like partner bank of Revolut doesn't really see what's going on at the client layer. They just get the money deposited in their bank accounts. So we already have seen technology overcoming some of the problems of an antiquated financial layer. We see this every day. I mean, we interact with fintech 99% of the times. What I think is happening now is that technology is like lowering the barriers of entry of fintech businesses massively. So if you want to create a fintech front end, some sort of like financial application for your clients, you don't need to actually enter into a never-ending negotiation with a partner bank that is going to store the deposits of your clients through an API. You need to send them the money. You just embed stablecoins in your code, and it takes probably 1% of the people to do that. So I think that a lot of the inefficiencies have been abstracted away from the ultimate client because the front ends have been intermediating this space between the bank and the client. But this means that the banking layer behind the scenes now can be completely redesigned in a way that we can build better, cheaper, faster iterations of front end financial use cases for the client. And this is actually what is happening. And there's so many use cases of this. Like I think many, I'm sure we're going to touch on later in the podcast, that we are facilitating as well. So this is already happening.
It's always felt a little off to me as a user of all of those financial technology platforms that you mentioned, where you have a relationship and really the main trusted relationship with the end platform, the Revolut or the Robinhood. And you come to realize that for most of these platforms, they're really just built on the backs of these very singular, like what you call choke pointed financial institutions that are playing by the same old rules. And what they've created is just a very beautiful front end, but it's still, and I think we've seen, maybe you guys can speak to this, I think a lot of downfalls from the banking as a service space in the last 12, 24 months, where that's gone really wrong when these companies who have user deposits or they have picked these partners and they do what banks do and have done throughout time, they fail and they fall short on expectations. If you can speak to that, or maybe the architecture that you guys are thinking through and how you've thought through recreating that, like from first principles, and how you've gone about that. Because I think, yeah, to your point, the world has gotten very comfortable and very used to that experience of just kind of, this is the way banks are, this is the way branches are. Like we've gotten very used to this. Would love to hear more about how you guys have approached challenging it.
And again, like they don't just fail to meet consumer expectations. They literally fail sometimes. Like that's the nature of fractional reserve banking, where they're taking all of this risk with your money and then they don't pay you for it. Whereas a stablecoin is also not taking risk with your money and hasn't paid you for it up till now, but it's a much fairer deal, right? Like it's already a superior product just from a basic financial risk perspective.
Fastball question on that specifically.
Mm-hmm.
What would you say to someone who feels like the word stablecoin or the idea of blockchains themselves feels risky? I think to a lot of people, they feel like this is new, this is innovative, and that just inherently feels uncomfortable to people. What would you say to that person when comparing the reality of what M0 is doing to a fractional reserve banking model in terms of risk?
I feel comfortable saying that M0 is significantly safer than a fractional reserve bank. Now, that is going to be dependent on whether your deposits are insured or what kind of product you're in, et cetera. But as a general rule, we're holding T-bills, right? Like our balance sheet is just much less risky than the average commercial bank. But I think the part where people feel risky, and rightfully so, is that crypto introduces a different component, which is self-custody. And we've all gotten very used to, as consumers, the idea that the bank protects us from ourselves. But also because of that, we started having really silly practices, like putting, I like to call a credit card a private key on a piece of paper. Like we're showing everybody our private key every time we make a payment. It's stupid. Whereas I think while people get nervous about how crypto will operate in the current world, they're not thinking far enough ahead, because you're a lot less likely to have your crypto stolen than you are to have your credit card stolen, because your private key isn't written on every payment that you make.
Yeah, and I have also another perspective on this. I think that we don't need to convince the ultimate user. As you were saying before, Drew, I think the user has a relationship with the application they interact with. Do you really ask yourself how Venmo is moving money? Do you really ask yourself what are the partner banks around the world that Revolut uses, or TransferWise, now Wise uses? No. I think you kind of trust it. Unfortunately, the end users are abstracted away from financial risks and complexities until things go wrong. But the positive side of it is that you need to convince the builders of financial applications. Now, what we want to do, I think in the stablecoin space, and same for the stablecoin, by the way, I think that this obsession about the brand, whether it's USDC, BDM, whatever, is really temporary. I think in the medium term, a user will interact with digital crypto native money by just seeing a dollar balance on a front end. They don't know whether this dollar balance is actually a combination of 7 different interoperable stable coins or one or stable in fiat or who knows. So I think this is, in my opinion, this is the future. And this is actually informing a lot of what we're doing at M0. We are building a universal platform for builders. Actually, if you want to embed dollars in your financial use case, it could be several, right? You can create a credit card like Cast, or you can actually power some sort of like gaming application or social application or whatever. If you want to embed digital money in your stack, we think doing it with M0 is way better because it's safer, because it's more transparent. It gives you the ability to control more the underlying revenue yield instead of single financial application, financial institution doing seigniorage. And it's more programmable, it's only with code. So our pitch is to builders to build on top. And they will build cool things and safe things for the users to interact with a much faster churn than before. This is our pitch. On the other side, because money is actually manufactured, you need reserves to manufacture money. On the other side, we actually creating one single infrastructure who actually holders of reserves to sell those reserves into. This is a distinction I want to make, and I don't want to take too much of the time. But at M0, we're really splitting between the idea of upstream and downstream of money. Upstream of money is those who have the reserves. Downstream of money are those who are creating the use cases. These people are completely different. Now, every financial institutions in this world is excited to build stable coins because, wow, look at the profits. So JP Morgan wants to build a stable coin. Fidelity wants to build a stable coin. Anyone wants to build a stable coin. Now, surprise, surprise, I don't think Fidelity is going to build Hyperliquid. I don't think JP Morgan is going to build Uniswap. What I'm trying to say, or no Revolut for what matters, or Robinhood. So I think that these two personas are completely different. And I think M0 wants to be the middleware that intermediates both. So largest market in the world in terms of demand applications that integrate to actually connect your collateral machine into the most programmable and most transparent, highest quality platform for builders to build very cool use cases embedding dollars on the other side.
And in some ways, it does model the existing, at least in the upstream and downstream framework, it does resemble slightly what a custody or a bank system is, where you have people who are providing value, and then you have other people who are using that value in another way. And there's a need to have an intermediary there that is involved from an infrastructure standpoint, which is really interesting how you have taken and recreated this model. I'd love to dive into the model itself. You mentioned that, just practically speaking, I know you guys have really started and been very clear on how everything is backed, just to get that out there and make sure everyone knows what that means with treasury assets. Could we just, cover that real quick, and then how you guys think about why US treasuries versus other things? And then we can, get into more of what I'd love to start with is just really that from the backing, and then we can work our way up to eventually the application layer of what people are actually building here. Would be great.
But can I just add one thing? So I think what Luca said was very important, because it's hard for most people to understand what our protocol does. So like, we are that connection point, right, that he was describing between the upstream and the downstream. I think another useful analogy here is any other physical business where a retailer buys from a wholesaler. They don't manufacture from vertically down. Like Circle's doing this vertically. They're manufacturing the goods. They're skipping the wholesale component and they're pushing it right to retail in some cases. We are the wholesale agent in this equation, at least in my opinion. So we interface with the manufacturers. These are the issuers that are upstream. We have many of them. We manage it for the end customer. And then we sell down to the retailer, who is the one managing the end use cases. But when you go to the store and you buy something, you're not buying something where the store you're in interface directly with manufacturers. They deal with wholesalers. And I think in stablecoins and in crypto in general, this middle layer has been missing, and that's where we sit.
I really do appreciate that. So you guys, let's just say Walmart or a big box store, and you guys have relationships with a lot of those companies who are issuing products or stable coins here. Today, we just saw that amazing announcement with Braille. Really excited to hear that. Does that fall into this? I'm assuming, like, this part of the stack, these issuer partnerships. Maybe speak a little bit about what that layer consists of. I feel like there's a lot here of really the value. If I'm downstream and I'm thinking about upstream, there's so much nuance to all of these different issuers. Maybe we can park here a little bit. Like, tell us more about the kinds of issuers you're working with, this part of the stack specifically, the Braille announcement, anything on that would be great.
Yeah, I think this connects to your previous question. I start, and I'm sure Greg can complete my answer. So the reason why we called M0 is because we thought that we were really, first of all, we wanted to create the layer 0 of money composability. And also because we thought that we wanted to recreate the best on-chain comp for cash, for M0 money, not M1 money, not bank risk. So M0 wants to be, if you see the M token, which is this sort of wholesale building block that is produced by the M0 protocol. In our opinion, the M token is the best on-chain proxy of risk-free there is. And it's difficult for people who are not really deep in finance to understand stablecoins, because stablecoins are a kind of a hybrid new money market instrument. Kind of a bank, they look like a bank deposit, they look like a payment rail, they look like a money market fund, but it's a combination of those. Now, in our opinion, M is the cleanest on-chain comp to risk-free there is. So in order to do that, what is the reserving of this? This reserving should look as close as possible to risk-free. Now, we are starting by actually approving in the reserves only instruments that are as risk-free as possible. So US short-term treasuries under 6 months of residual maturity in any form, being those held in off-chain so-called trust structures or in tokenized form, because that part of the stack is going to evolve a lot. So if you go on the dashboard of the M0 project dashboard of M0, you will see like at the single ISIN level with daily validation, what are the instruments that are backing this. Superstate is the first tokenized collateral that we are absorbing, but there might be others. Now, I think that this level of homogenization and transparency ensures that on the other side, on the downstream, people do not really care. They trust the fact that the M is as good as it gets. They can validate the reserving if they want, but I think we want to get to a point where M is really considered as pristine as possible for people not asking questions. And we are doing this through quality and transparency instead of through mystery like Tether. Now, that part of the stack currently is highly regulated to issue, to actually pledge a collateral and produce a stablecoin. And that is what the minters, when the minters come in, right? We have M0 had the first minter in the BVI, which is called MXON. With Braille today, we announced that we're starting a process because the Genius Act is actually, we're very happy that it's actually compatible with our vision of the world. Braille will manufacture and produce a token in a US compliant way for people who actually need to build on top of a permissible approved stablecoin in the US. So in our opinion, the minters are regulated manufacturers in this manufacturers in this like kind of like permission marketplace, as Greg was describing it. Now, in my opinion, the upstream of money will evolve massively over the next decade. A lot of this stuff a lot of the collateral will become tokenized, really tokenized, will be smart contract led instead of like trust structure led. And maybe we go to a position where actually issuing the stablecoin, pledging this collateral is so safe that you don't need to be regulated either. You can just participate into an ecosystem. The beauty of what we're doing is that the downstream of money will be abstracted away. The same way you swipe a credit card, you don't know, but I'm sure that behind the scenes, the credit card companies, they keep improving their rails. Same way, like we will keep improving the framework to manufacture M, and this will be abstracted away from the people who have taken that M and they have already embedded it into their stacks. This is something that doesn't happen with tokenized collateral. If you want to embed tokenized collateral today or other stuff, it's very cumbersome, it's very convoluted. So we're super excited to announce the partnership with them. We're super excited that the US have moved into this direction because it's not what we have seen in Europe, because we think really that the US are hopefully striking the balance between being very conservative to protect the consumer, but at the same time being open to innovation outside of the traditional banking space.
Yeah. And Greg, just to round that out a little bit, going back to the question on like specific issuers, what makes them unique? I know, Braille they hold a ton of MTLs in the US. They're I know they've built really in-house their entire wallet stack custodially. Maybe speak a little bit to the nuances of that, that part of the stack and where they sit, and maybe any thoughts on Genius Act too, since we brought that up.
Yeah, that part of the stack is the purpose is actually to make sure they're not too unique, right? You want them to be quite standardized in what they do and to follow best practices. Now, the unique part comes about jurisdiction. So in the US, you need certain licenses. In other countries, you need different licenses. So I think they have a very jurisdictional focus, and they also have a very structural focus. They need to be able to set up these entities correctly. They have to work with the right law firms to make sure that things are operating smoothly. But from a technology perspective, that's really where we come in, because we're taking that part for them. If you think about the vertical integration of a stablecoin, kind of the way Circle does it, you have the manufacturing. That's when you go out there and you reserve and you mint the stablecoin. And then you have the standardization and the distribution. And the distribution is happening on the other side of our protocol. Our protocol is abstracting away the complexity of issuance so that end integrators only have to worry about one thing, and that's the M token. So just to make it very literal, like if you're a person building a stablecoin on our platform, you are just using it. You don't have to worry about any of that upstream stuff. That's completely on the other side of the wall that is the protocol. And what you're trusting is that our protocol and what we've built will manage that appropriately.
So for example, before this, maybe give us the before and after reality of what this partnership with Braille unlocks, for example, and how like you said, Visa gets better every month. They're adding new functionality. Like, what is the before and after of what this unlocks, maybe for a US business or something like that? And also if there are any gaps in the system or opportunities that you see in the future that you're hoping to achieve next with the next issuer partnership or something like that.
So right now we can't sell to a US business. Like Luca said, our current issuers based out of BVI, they can't do business in the US. Braille allows us to do that. So Braille has money transmitter licenses here in the States. And once they are up and running minting M, they will be able to sell that to the integrators that are stateside, which we don't have today because we can't. So it's a pretty big unlock because it's obviously the largest financial market in the world, but this is the short term. The medium term is when Genius comes into play, which allows us to do truly proper issuance in the States because they've baked the things that we've been asking for into the legislation, like consumer bankruptcy protections, et cetera.
Yeah, and interesting. Sorry to interrupt. We stayed away from the US beyond the obvious political anti-crypto political agenda that everybody has talked about, because it's true. We felt it as well on our skin. But the reason why we stayed away from the US, the reason why we're still staying away from Europe in terms of business development, is because, funnily enough, M0 requirements in terms of solvency and quality of the stablecoin are way more stringent than the European ones. We will never accept to actually have 30-60% of the reserves sitting in some sort of unsecured bank deposit. Why should we? The customer doesn't want it. Why do we need to subsidize regional banks in Europe? So that's why we've been very resistant. Now, as Greg was saying, the Genius Act is actually recognizing this reality and giving the option to the consumers actually to take the risk they want. That's why we're coming to the US. Now, the other side of it means that whether M is manufactured and distributed in the US or in the BVI or in Singapore or in Australia is the same quality asset, because the quality are actually enforced at a protocol level. What is important for the regulator is that until now, I think this will change when technology will really be the enforcer of quality, but it's not the case, is that the regulator wants to make sure that there is something circulating in their own sovereign ecosystem, sovereign market. They need to make sure that there is someone who is responsible to make whole the consumers if something goes bad. And obviously that level of responsibility in our case are the money transmitters that have license to operate in the US. The quality of the token behind the scenes is the same, because we're really being very strict in enforcing rules across the whole ecosystem, which is important to have like a singleness of money, unique monetary system, which is the basis of everything we've been discussing so far.
And the high level, from what it sounds like, is MiCA in Europe is requiring some sort of ridiculously high reserve. You said 30 to 40% reserve roughly of, if you guys were to operate there, you'd have to pipe that reserve into the banking system and have really that outside of the system inherently to work.
Non-interest bearing deposits into US dollar deposits into European banks. So completely uninsured, 0% interest, just purely subsidizing the balance sheets of these mediocre banks.
Right. And then the Genius Act is countering that by saying, the model that you guys have talked about, the singleness model where, everything can exist natively in this type of system is supported. And it's actually regulated and there's nothing prevent. Is there anything in the Genius Act that gives you guys concerns or things that you would challenge, or does it actually seem like, yeah, this is incredibly bullish and we're huge fans of how it's written?
If it passes as is, I think it's the latter because it's very flexible. It inherits the permissible investment framework for money transmitters, which just says, hey, as long as we checklist it as something you can invest in for this stable money instrument, go for it. You can have 100% of the reserves in that. You can have zero. It doesn't matter as long as your entire composition is of those whitelisted assets, so to speak. And then on the other side, it doesn't get too prescriptive with the overt regulation. It pushes that to the states primarily. So each state can choose their own regulatory framework as long as it's compatible with the federal one. And only once you get above a certain size do you have to be federally regulated, which is great for a protocol like ours with multiple issuers because it encourages actually more issuers to join that are below that federal threshold.
Yeah, there are three things that make, nothing is perfect. Obviously, everything needs to continuously evolve. But there are three things that make me super excited about the Genius Act. The first one is what Greg was mentioning, super seniority of the liability holders in stablecoins. That means if you actually are a depositor in a bank, you are protected by, let's say, the regulator or the deposit insurance scheme up to a certain threshold. And above that, you're just an unsecured creditor to a bank. This is not what happens under the Genius Act for stablecoin holders. If you hold $10 million of stablecoins issued by a stablecoin issuer in the US, you have super seniority if something happens on a bank from bankruptcy proceedings, in simple terms. This is massive. Makes stablecoins, approved stablecoins, covered stablecoins safer than bank deposits. So this is number one. The number two is the ability to actually not to use bank deposits and to actually use tokenized instruments as well. So I think that the law is saying, okay, we would like you to have money market, money risk-free reserves. It doesn't matter what's the form factor of those reserves. It may actually be tokenized as well because the future is actually moving in that direction. This is super exciting because it means that you don't need to have some sort of very weird paper-based trust and a set of API, trust structures instead of API. You may actually have a set of smart contracts interacting with tokenized securities by the likes of BlackRock or Superstate. And then the third one is about the threshold. And this goes against the thesis of massively centralized stablecoin issuers. I will say this on record. I wrote it actually recently. Massive stablecoin issuers, centralized stablecoin issuers are a critical choke point and single point of failures in the monetary system. They can have disastrous consequences. And the regulator is aware of it. It's not good. We actually don't need them. So they might pitch it as much as they want, but we don't need an issuer with $500 billion of reserves. Has potentially destructive risks for the monetary system. So what the system is saying, we will disincentivize massive issuers because they are becoming too big to fail. So we will hyper-regulate them, making their business actually not very profitable. So we actually incentivize people to stay below a threshold, which I believe is $10 billion, if I'm not wrong. That is actually great. And that actually incentivizes coordination protocols like ours that actually can allow smaller issuers where the risk is more distributed to actually act as part of a single liquidity layer, which is super, super important.
It seems like it naturally, it goes to bare foundations of an entrepreneurial system, or incentivizing people to start things that are smaller and can exist in a more meaningful way. And when you look at the exact opposite nature of what too big to fail banking has been in the last decade, 2 decades plus, we live in a banking system where that's the exact opposite reality. I love the idea of, maybe I'm a little bit more romantic about this, where I grew up and where I live, there are a lot of community banks and small banks, and these banks that are started and managed and governed in many ways by people in the community that have been, I think, through also what you saw with a lot of the 5 years ago, the COVID support and the ways that these banks were bailed out and things that happen, and the way that the regional or community banks have been really under prioritized or under given special treatment compared to the big ones. It seems like the sort of incentive system here is way more favorable toward, I know these aren't necessarily banks, but it incentivizes people to be able to grow meaningful businesses, but they don't need to be these massive monopolies for issuance. They can be meaningful, but relatively small at the same time.
Yeah, but I also want to kind of go deeper into this point, because if I was listening to this episode, I would be like, all right, that's not a critical enough assessment of this, because the banking system already has this two-tiered approach to it. You're either globally systemically important or you're not, and they make it a lot harder to be a GSIB than it is to be a community bank. So it's not like there isn't already this two-tier approach. The difference is in the way we're approaching the singleness. So the way that they approach it is through fractional reserves, right? You have to go to the Fed, and then if you don't have enough reserves at the Fed, you're done. And if you're not one of the GSIBs, you're not getting bailed out. SVB got bailed out, but there's no explicit promise. So the deposits just keep flowing into the GSIBs. We handle it very differently, where we say, all right, we're going to handle the singleness at the collateral level. You're all going to literally be the same underneath the hood. And that way we know that none of you can fail. So I think it's a very different structure, and it's important that something like M0 is the powerhouse of that structure, because otherwise, without that enforcement, you're just going to end up with the same system with the Fed replacement that's acting as a clearinghouse for all these different stablecoins.
That's huge. Luca, any other thoughts on that? It's a key point.
Yeah, I mean, just two very quick ones. The first one is, I agree with Greg. At the same time, I think that we are at an inflection point that is going to be problematic, because a lot of liquidity is going to flow away from banks, and banks do credit, and what the so-called fractional banking system is needed to do money creation. So I think that part of the M1, let's say, the credit creation, will need to go through significant innovation, also regulatory innovation in the next decades. But they need to. There's no way around it. So trying to protect the outflow of money, it's not going to save a sector that needs to innovate itself. We don't need these monolithic banks. So I think that the M1 credit creation of the money creations part will also become significantly different. And the regulator is aware of it, so he's trying to pace this transition, but this transition is inevitable. And the second part is, and this is, sometimes we forget where we come from, this is crypto, guys. I mean, we are in crypto because we believe in distributed networks that are powered by technology, that there is no single point of failure, and then there is no single gatekeeper that is going to absorb most of the upside and dump most of the risks in the rest of the network. This is literally why we are here. So I think this is a battle worth fighting for the rest of our lifetimes, because this is why this sector exists. This sector is not payments.
I have to jump on that, because I've been in crypto since 2010, so I get a lot of like your trader looks for being in stablecoins, because a lot of people don't think stablecoins are crypto. They're like, no, you're just now perpetuating the TradFi. And I'm like, no, you don't get it. Bitcoin set out to destroy the banks. Go look at the Genesis block. That was Satoshi's explicit mission. Stablecoins are how you destroy the banks. You were going to force them to transform into something that's better for the consumer. And if that's not the goal of crypto, then I don't know what it is.
That's epic. Stablecoins are an interesting, I don't know, the word crypto and stablecoins. What's the relationship? I started myself as a Bitcoiner. I think a lot of folks, came down the stablecoin rabbit hole from Bitcoin in some way. But yeah, I totally agree. I think that we're finally at a point where what you guys are building and the infrastructure that it is can actually do what we're talking about, and not just like pontificate on it or ideate on it, but actually there are companies right now, I think about Cast, for example, who's on the season, who are building. If they continue to do what they're doing and grow like they're growing, they're going to do it. They actually are sort of doing what we're talking about. As we, turn the corner here with the conversation and think about the application layer or the downstream part of the business, talk a little bit about what gets you excited. We've talked about like the infrastructure of the upstream side. What about the downstream side? What are maybe some things that you guys are hearing from companies that are coming to you? And I'm imagining you guys are having a lot of really exciting conversations around what people are trying to accomplish. What are you hearing? What are people trying to build with this infrastructure right now?
I can start, but this is really Greg's arena to shine. But I think that this is I think this is the most important point. What we're building is very first principle oriented, and people can trace back our beliefs because we have been in the space for a long time. I personally have been writing about this for a long time, so people can really see where I'm coming from a design perspective. But ultimately, you need customers, right? You need to build cool things. So that's why being regulatory compliant is not a moat that is going to let you win. Having a very elegant infrastructure is not enough. And we have seen this in crypto many times. People building super cool layer ones and nobody uses them. So what makes us very, very excited, and I'm sure Greg can talk more in detail about the integrations we are working on, is that on the downstream side, so people that are building cool stuff with our tech for their end customers, we are seeing incredible traction because these people speak our language. So like these people say, wow, I can actually program, control the yield, have full visibility, full transparency to embed a stablecoin on my stack stack and inherit the shared liquidity of this system? Do it only with code, with people that understand me and people that are building with me? Ultimately, business is made by people. And this is why it makes us very excited. Like what is making us very excited? Like Noble, for example, we've known the Noble team for a long time. They want to build the canonical stablecoin for the Cosmos ecosystem. We speak the same language. We designed it together. We designed let's say we adapted the engine under the hood for their use cases on the Noble chain, and they are perfecting the mousetrap, so to say. They are perfecting actually the distribution side. And we speak the same language. We speak the language which is code. It's not the language of sales representative and KYC, KYB, speak to the compliance guy. This is not how we do business. And I think that a lot of this is perpetuating in our pipeline. So you have seen that there are teams that are building a stablecoin on M0 for the hyperliquid ecosystem. There are teams that are building forecast on Solana ecosystem for crypto native new banks or credit card issuers. There are others that we haven't announced yet that are building in the gaming space. There are others that are building for DeFi, like the guys at Usual, right? So I think that we speak their language and we solve problems for them, which is abstracting away all this regulatory reserving complexity, having super high quality hyper audited code, dealing only with code and just managing the liquidity infrastructure on chain for them. So they don't need to do anything else. And this is the most important thing. Like we want to get to a point where teams can bootstrap a stablecoin on M0 stack in a matter of like minutes, and they can do whatever they want with it. And I think this is how success is 80% or 90% execution, and that's what we're focusing on.
Yeah,
I'm sure Greg can add a lot on this.
Yeah, we're coming out with this episode first, so on the season, shout out to some future episodes. If you're listening to this, we'll be sitting down with Cast, the Usual team, the Noble team, some of the teams that Luca just mentioned. So stay tuned for that. Greg, other thoughts on this point on the application side from you?
Yeah, it's a very hard question to answer because we see such a diversity of use cases for our product that it's almost impossible to pin down a common denominator. If I had to do it, the common denominator is that they're all very tech forward and they appreciate the fact that everything's on-chain, programmable, and modular. So just to give you some examples of why that matters, like as Luca said at the beginning, we're in like the .com era of stablecoins. Everybody wants to slap a brand on it and everyone wants to, make sure it's their dollar, right? That's going to go away. We're going to see a world where you go into an app, you just see a dollar balance and you're going to have, as a consumer, no idea what powers that dollar balance, but behind the scenes, it will be something like M0. And when we build those companies an extension, as we call it, which is a wrapper of on-chain, what they really want is control. They want to control the stack and control the features that are surfaced to their customer. So those features can be things like Luca mentioned, which is yield programmability. So because everything is going through AMP, it's not like our competitors who will write you a check at the end of the month and say, here you go, there's your share of the interest. Everything we do is streamed on chain instantaneously. So they have the ability to do custom yield splits per consumer, per address in their system, or take all the yield themselves, repurpose it as rewards, whatever they want. And it's all on chain instantaneous. Others are compliance, like Circle and Tether, they have to vertically integrate compliance. They have a compliance department. Well, there's companies out there that specialize in compliance, and we can let them hook into your extension and effectively run compliance checks that you specify on chain before any function in your stablecoin is called. So if I had to identify what the common denominator, and again, like Luca said, we have people that are doing global distribution on Noble Chain. We have specific consumer apps like Cast. We have aggregators like Usual. We really see just the whole spectrum of dollar use cases building on top of our stack. But the common denominator is that they value our tech forward perspective.
It's amazing. And this might be a dumb question, but you're saying that if I'm working with a, big regulated centralized issuer for some like go-to-market partnership, they're actually going to like mail me a check at the end of the month? Like, is that actually how it works?
That might have been a bit of hyperbole. They'll probably send you some stablecoin. Like they'll probably mint a bunch of stablecoin and send it manually to your address.
On a periodic, like...
Yeah, whenever you agree or ask them for it.
Okay.
Like a dividend almost.
Yeah. And so with M0, it sounds like this is more of a stream of money that's coming in based on...
Native to the protocol. So we have an index that's constantly updating that just continuously updates the balances of people eligible to earn the yield.
Yep. And so the T-bills on the infrastructure side that is collateral, that's going to be I'm imagining a fluctuating rate, but that's a shared rate across the system. So whatever that is, that's a shared upside across the system.
It's even better and a bit more complex than that. I think that, and this, like, we inherit this from the maker world. Stop me if I'm getting excessively nerdy on this disclaimer. I think that we are not tokenizing. I mean, I joke that tokenizing, in my opinion, tokenizing treasuries, it's just like scanning a physical photograph. I think we're actually splitting this. I think that it's a matter of incentives. So let's say you are a minter on the network. So you are actually the one posting the collateral and minting the stablecoin. So the protocol is going to charge you, let's say, a fee. We call it a minter fee to mint the stablecoin. So the stablecoin is a crypto native instrument, is accruing interest on a continuum basis. It's the minter rate. Now you will do this as long as the minter rate is at least as lower than the yield of the assets on the reserve side. Now the assets might actually have a coupon every month or no coupon, or might be public, private. It doesn't matter, right? It's like in the securitization system. But you just know that you will keep the difference between the asset yield and the minter rate at the end. So you care about this balance. But from a protocol perspective, the protocol completely ignores it. The protocol is just making sure that the assets are there and are validated, in our case, are super transparent, super safe. It's just charging you a continuum interest rate, let's say, and is absorbing this interest rate. And then is rebating it to those that integrate with them, to earners, and only to approved earners. So there are several monetary levers here. You can actually incentivize minting by bringing down the interest rate. You can incentivize adoption by maximizing the minter rate, which is what we're doing now, and having the earner rate as high as the minter rate. But imagine a future where half of the float, which is probably very extreme, but just to give an example, half of the float of AMP is not actually permission to earn because it's used as some sort of payment instrument. You might actually pass downstream to earners a risk-free rate, which is double the risk-free rate, because then the earners are doing seigniorage on the rest of the stack. So it's is more complex than that. That's why we built a protocol. It gives us flexibility to actually manage the monetary policy of it. Very simple monetary policy. There is nothing degen about it, but also is allowing us to manage the yield component of this in a completely crypto native way. So there is not a calculation agent that is calculating the NAV of the treasuries and then is pushing a button every day or every week, every month to rebase your token or to send you USDC because you actually signed a piece of paper with Circle that because you're very cool, they're going to give you the money at the end of the month. No, this is not the case. It's only code. And you just manipulate code in the way you see fit based on your use case.
And to Greg's point, it sounds flexible. So if I'm Rags and the cast team, I can potentially come to you guys and maybe have the flexibility to say, I'm just imagining, would Cast be the minter in this use case, or would their users be the minters?
Cast is what we call an extender. So they have an M extension called Cast Dollar. And what it does is it gives them the ability to collect the yield that's associated with their users' balances and then distribute that however they see fit. Now, I imagine they're going to do something like a rewards program for people holding Cast Dollar, but I'm sure if you use the app, the much more impressive thing is that you can go anywhere with a credit card and pay down from that account instantaneously. And that's yet another benefit of using the M0 network because you tap into our shared liquidity. So we have all of that's on chain as well. We have UniV3 pools today, but we are currently in the process of launching UniV4 pools that are built with compliance in mind so that institutional capital can reach them as well. And we also, just as a side note, see this being a major trend that we want to tap into. The pairing of institutional capital with on-chain infrastructure is becoming very powerful and happening very quickly. You're seeing it at Coinbase with things like Morpho and UniV4, and now we're going to be launching our UniV, which will only allow for KYC counterparties to swap, but those counterparties can be solvers, market makers, et cetera, that can bridge liquidity around the ecosystem.
Wow. What other things are you guys really excited about in the future that you're building? I feel like there's so much happening and so many partnerships, at least right now, that we've been talking and working together for many months, it seems like. And as of late, it just seems like the partnerships and the downstream side is really heating up. And there's some really, really awesome realizations of what you can actually build with M0. Would love to know any more of what you guys are getting excited about on the downstream side, or maybe Greg, what you said on just more of the infrastructure upstream compatibility or reality of what you're building as you guys look into the remainder of the year.
Yeah, and I'll let Luca tease the partnerships because I don't remember all the NDAs in my head. He does. But One other thing that I can point out is like we're making a large cross-chain effort right now. So we already have our EVM code audited, ready to go. That's on a bunch of L2s, but we just last week launched Solana. So now we have an SVM version of the protocol. And I think it'll be public by time this episode airs, but we're coming to SUI as well. So yeah, we're really pushing cross-chain. We use both Wormhole and Hyperlane for messaging. So yeah, we have a huge breadth of opportunities for different application developers, regardless of where they want to deploy. And of course, we have Noble Chain and Cosmos.
Awesome. Yeah, we're going to have Wormhole as well on this season. So it'll be fun to dive more into the messaging side. Any thoughts from you, Luca?
Yeah, I think there are like a lot of things that make us excited, but now like there are more partners that come to us with great ideas and they want to build on top of M0 every day, which is what excites us. We're doing a lot of groundwork to actually unlock as many ecosystem as possible and as much liquidity as possible in the most efficient way. There is a lot of like work that has been done in crypto currently on liquidity infrastructure. And in our opinion, non-crypto people, they obsess themselves with solvency of the stable coins. They say if you are like a financial institution, you want to issue a stable coin you think is super cool because you know how to do asset management. Yes, this is very important. But the most important, and the Tether story told us this, the most important thing in stable coins is interop and liquidity. This is the most important thing. And we will spend an enormous amount of time, effort, and funds to make of M0 and the most interoperable, seamlessly interoperable and liquid system on chain there is. And this is a never-ending effort, right? And the beauty is more people build on this, and the easier it is for others to enjoy this kind of like virtuous effect. This is not what happens in centralized stablecoins. If you're very successful in bootstrapping a centralized stablecoin, you are making the next success story more difficult, and so on. So you keep fragmenting the business. So I think that there are use cases that are making us very excited, and more use cases when unlock larger use cases. But there's one thing that I want to make sure that I say before we finish this episode, and I stole this from Joao, who is the chief strategy officer of M0 and the grandfather of stablecoins, having built USDC at Circle before he decided that it was about time for him to build something else with someone new. Especially when you go to talk to investors, they all wanna hear the story. Okay, when are you going to onboard Robinhood? When are you going to onboard JP Morgan? I have a lot of respect for these companies, but this is not what we're doing. I think that we want to help the next Robinhood to grow. That's what we want to do. And the parallel that Joao always does is with Stripe. Stripe was born serving the DoorDash, the Uber, the Airbnbs of the world when these teams were small startups and they wanted to interact with easy, smooth payment rails. They didn't go after JP Morgan or Visa. And then fast forward 5, 10 years, 15 years, those companies are gigantic and Stripe grew with them. And that's what we want to do. We want to empower the next generation of fintech massive success stories to become what they will become. And those will not be JP Morgan, will not be Robinhood or Revolut. Those will be Noble, will be Hyperliquid, will be Workcoin, will be Cast, and we will be the infrastructure powering them all. That's our ambition. We don't want to make the big guys bigger. We just want to help the next generation come through.
I love that. So inspiring. What would you say as we close here? It's a great place to close. What would be your call to that builder or your invitation? Maybe I think there are a lot of companies right now that may be unaware of what's possible. And I think a lot of them are building with what in their minds is the tools that they have at their disposal, which are USDC, USDT, these liquid stable coins. What is the invitation or the message to those builders as we come here to a close?
I'll take this and I let Greg close the episode. But what I will tell them is just to come to us. We speak your language. We want you to succeed. We will not bother you with cringe boomer type of requests. And especially, we raise significant money and we will raise more so that we don't charge you anything for it. We don't want to sell you technology. We don't want to feed on your business models. We want to scale as an infrastructure to actually be in a position to be massive and have a small yet fair share of your upside, but most of the upside should be with you. so that you should come to build with us, because we raise money, we work every day actually to make your business massive. And I don't think there is any other company that has the long-term commitment to do that. To do this, you need long-term supporters. We have had investors alongside us from the very beginning, guys like Pantera, Bain Capital, Galaxy, Air3, Road, and many others that have the same long-term vision. They know that they need to invest for the long term to build great infrastructure, and that's what we are. So come to us. We speak the same language. We operate the same speed, and we don't want to sell you anything. We don't want to lock you in anything. We just want to we want to build so that your business becomes massive, and we share a little bit of your success.
It's awesome, Greg.
Yeah, I'll take a little bit of it. Everything Luca said, but a little bit of a different approach. You don't have to come talk to us. So like we pointed out, we are a code first protocol. You can go talk to our competitors and spend 3 months negotiating with lawyers and signing agreements to get your stablecoin up and running. But you can do the same with M0 in 3 minutes. So everything is on chain. Our code is audited in public, and it's very easy to deploy your own contract. So I'd love for you to talk to us. I'd love to hear what you're building and learn about how we can help you. And maybe there's some custom features, but if you want our standard feature set, just go deploy it. You don't even need to ask us.
Thank you guys for the time. This was really great. I absolutely love what you're building, and thank you for supporting this season. It's gonna be really exciting sitting down with the downstream partners that you guys are supporting. They're building some incredible things on chain that are doing what everyone is setting out to do to challenge this banking system that we've talked about has some pretty big downsides and innovation coming for it. So thank you guys for all the work you're doing.
Thanks for having us, Trip.